So hello friends, hope all of you are doing fine. I must first compliment you for the excellent feedback that all of you have shared for our first episode on ETF Ke Funde. This feedback has given us the energy to try and decode the world of ETF investing to all of you in a simple manner. So please keep sharing your feedback, and your feedback will help us improve the way we communicate with you. In the second episode, we are going to discuss on the topic of what is ETF and also try and explain how it is compared to mutual fund schemes. So like I had mentioned in my introduction video, ETF stands for Exchange Traded Funds. So an ETF is, in simple words, you could say it as a security which you can buy through the exchange. ETFs provide you the two benefits of buying a security and buying a mutual fund in one product. So a mutual fund which can be traded on an exchange is how you can simply understand as ETFs. One logical question that will come in your mind is what type of asset classes can be invested through an ETF. So the beauty of ETF is you can create an ETF product on various asset classes, on equities, on fixed income, on commodities like gold, or even international equities. Essentially, an ETF mimics the performance of an index. In fact, ETFs can also be created as a fund which will invest across multiple asset classes as well. The beauty of ETF is that in buying one security, you get the benefit of making a transaction across the entire portfolio. So let me give an example. Say if an individual wants to participate in the growth of India and he thinks that Nifty 50 is the index he should invest in, he can buy a Nifty 50 ETF. Now when he buys the Nifty 50 ETF, he gets the performance of all the 50 stocks which are a part of the Nifty 50 index. So just by buying one ETF, you're able to get the performance of the 50 securities part of the index. This is how simply ETF provide you exposure for a large basket of securities. Again, one of the beautiful aspects about ETF is that it is traded on the exchange, and like a security, it gives you the benefit of taking advantage of the price movement that happens of any security. So we are seeing that equity market is considered an asset class which is volatile in the short term, but less volatile when you increase the time horizon for longer periods. If investors want to take advantage of volatility that might happen in the short term, you can take advantage through an ETF which lets you buy at intraday prices. Now friends, what I would now like to do is share a slide which shows how ETFs and mutual funds are similar to each other and how ETFs are different from mutual fund schemes. So ETFs and mutual funds, the similarities of both these products. So first, similarity is you need professional management. So in case of a mutual fund, you have a fund manager who tries and chooses stocks, securities based on the market views. Similarly, there is a portfolio manager for an ETF as well. So portfolio management or expertise of fund management, professional management is one of the similar aspects of ETFs and mutual funds. The second advantage is portfolio diversification. I think one of the most important things that we've learned is diversification. So when you invest in a very small segment of stocks or securities, the chances of you getting wrong is higher. But when you diversify yourself across securities, then the chances of you to making a mistake is lower. So an ETF or a mutual fund has a diversified portfolio across securities, and that helps you mitigate the risk of having concentrated portfolios. Now, investors need to read the scheme information document for each of the funds, be it ETFs or mutual funds, to understand what is the objective of the fund and where it will be investing. The third, We are seeing that in case of mutual funds, you can have mutual funds as large cap mutual funds, mid cap funds, you can have sector or thematic funds. Similarly, in the case of an ETF, you can have funds based on market cap themes, on sector themes, based on asset class themes. So the similarity between ETF as well as mutual funds is that you can run different strategies in one portfolio. Now let's look at some of the differences. And in some of those differences, you can clearly see the visible advantages an ETF provides to investors. First is the low cost. Now globally, like I had mentioned in the first video, passive funds AUM has now crossed active funds AUM. And why that has happened is because of the low cost of passive funds. Let me give you an example of the Indian market scenario. In the case of India, in case of large ETFs, which are like Nifty 50, you would see mainly those ETFs having an expense ratio on an average lesser than 10 basis points. But when you compare that with large cap funds, on an average, their expenses will be north of 2%. So clearly, investors can benefit from the low cost that the ETF provides. Second is it's traded on the exchange. So first is mutual fund. When you want to make a purchase, you can get the closing NAV of the fund. But in the case of an ETF, because you are buying it on the exchange, you can get the benefit of the intraday price of the security. So the difference is it is traded on the exchange and you can get the benefit of intraday prices. And these are very, very good benefits a lot of investors can take, especially when market conditions are volatile, and they can take advantage of volatility to buy at intraday prices which could be lower than the closing day prices as well. The third is replicating the performance of the index. In the case of a mutual fund or active fund, like we had discussed in the first video, the fund manager is essentially trying to select stocks, securities to give you performance better than the benchmark. An ETF actually doesn't try to beat the benchmark. It mimics the performance of the benchmark. So the idea is to give, in simple words, beta exposure, while the mutual fund schemes try to deliver alpha. And fourth, I think so, which is a very important benefit which ETFs provide, is the transparency. So you can go on any mutual fund scheme where you would like to invest through an ETF, and you will be able to see the daily portfolio of that ETF. While in the case of a mutual fund, you can only see the monthly disclosure of the scheme. So this is how ETF and mutual funds are different. Another different fact could be that ETFs have no exit loads, but in case of few mutual fund schemes, there may be an exit load. So investors should take this in mind. So the idea of discussing what ETFs are and mutual funds are in this episode is to make you understand how ETFs are different from mutual funds, and also highlight some of the unique aspects of what make ETFs having certain advantages over normal mutual fund schemes. As I said, the entire endeavor of our ETF Ke Funde series is to make the world of ETF investing simple for you. Hope this episode has been in the same way of helping you understand ETFs in a simple manner. So thank you everyone for your patient listening, and hope you continue sharing the same feedback and enthusiasm for our series, which will help us make the world of ETF investing simple. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.